Money on my mind, looking for a dime. James Locke in the house, gonna help you shine.
Welcome to the Poole Locke YouTube channel. I'm James Locke. Today we're going to answer some of the Ask James questions of the day. Our first question today is from Cameron. He says, bonds have been pretty lackluster over the last decade or so. Do you think that will change? All right, Cameron, good question. And hey, at least, Cameron, you're not hating on bonds, right? Sometimes you get questions like this. I expect some hating on bond conversation, but no, not this time. Good for you. You're absolutely right, Cameron. Bonds have been very lackluster, and part of it's because of the lower interest rates. So if you bought bonds 10, even 15 years ago, if you bought a government bond, there's a good chance that you were locked in at 2.5%, maybe even 1.5%. You were locked in at a very low interest rate, and because bonds lock in, that makes it a lackluster return. But Cameron, suddenly, now your bonds dropped in value, right? And that made it even worse. So yes, the returns for the last, decade and a half, Cameron, with bonds have been pretty lackluster. Now, what's different in today's interest rates, since they're higher, so if you're talking about government bonds, for example, we don't always talk about it, but if you talk about government bonds, specifically a 10-year bond right now, it's 4.5%. So it's not, it's not 1.5 or 2.5%, it's 4.5%. And with the Fed movements now, if anything, tend to be lowering rates as opposed to increasing rates. That means you could get 4.5%, and the bonds could actually go up in value over time. So again, you're locking in a better interest rate at a better time. So with bonds, it's all about when you get in. Right? That's the way it is with stocks too. It's all about when you get in. Same thing with bonds. It's when you get in. Now, if you're dealing with corporates, other issues, now you can get in at much higher than 4.5%. What I'm seeing now, is a real shift in the bond market that could benefit income-focused investors like you. The higher interest rate environment we're in today means new bond purchases can lock in those more attractive yields for the long term. And don't forget about bond laddering strategies, where you buy bonds with staggered maturity dates, which can give you both income stability and flexibility as each bond matures. For those focused on retirement income, high-quality corporate bonds are particularly worth considering right now. Many are yielding 5-6%, and some even higher depending on the credit rating. Municipal bonds also deserve attention for their tax advantages, which can make their effective yields even more competitive depending on your tax bracket. So Cameron, there's a universe of bonds, but there's also bond-like instruments available to you that can provide predictable income. Awesome question, Cameron. As always, if you would like to send in your question, you can do so by emailing them to poollocke@poollocke.com. Let's move on. Let's go to our second question from Edwin. And he says, you've talked a lot about preferred stocks, but aren't those riskier in general? Here we go, about a bond-like investment, right? Just like we were talking about with Cameron. So Edwin, well, they are riskier than corporate bonds, yes, but perhaps not in the way that you're thinking. You see, stocks have different classes. And when you think of stocks, you typically think of common stock. Common stock really effectively doesn't have a par value or a face value. It did when it was issued many, many years before, but now essentially a common stock can go way up, it can go way down. There's no par value or face value. And it pays a dividend, and that dividend can go up or that dividend can go down. With a common stock, you're really betting on the management team and the future profitability of the company. Preferred stocks are more bond-like than they are stock-like, and they're more bond-like in several ways. Number one, they have a par value. They have a face amount at which they're issued, usually $25 a share for many preferreds. And that's where they get issued. Now that's often, where they get called in if the issuer wants to pay them off. So again, it's It's like it's a par value. It's a face value. Also, the dividend on a preferred is actually stated on the preferred certificate. So it's not just like a stock dividend where it can go up or down. It's stated. And if a company defaults on preferreds, many companies consider that to be like defaulting on debt. So again, barring a bankruptcy or a default, you can usually count on getting that income stream, that fixed income stream. And lastly, preferreds tend to fluctuate more when the bond market moves than when the stock market moves. So, okay, if they're more bond-like than stock-like, then why are they called preferred stocks? Well, simple, because bonds have a maturity date and preferreds typically are perpetual. They go on forever. For retirees focused on generating reliable income, this perpetual nature of preferred stocks can actually be quite attractive. You don't have to worry about reinvestment risk. That challenge of finding new investments when your bonds mature, potentially at a lower rate, right? And in today's income-focused environment, many quality preferred stocks are yielding between 5 and 7%, which can provide a meaningful income boost to your retirement portfolio. One important consideration I should highlight is the interest rate sensitivity. Because preferreds don't typically have a maturity date, they can be more sensitive to interest rate changes than shorter term bonds. So that's something to keep in mind when building your income portfolio. Diversification across different types of income investments remains crucial. So does that make preferreds a little bit riskier than bonds? Yes. But are they generally considered to be a whole lot more conservative than common stocks? Absolutely. Awesome questions today. As always, if you'd like to send in your question, you can do so by emailing them to poollock@poollock.com. If you like what you heard, go ahead and like and subscribe to our channel. I'm James Locke, your retirement income source. I'll see you everyone next time.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me make it clear. Savings in the bank.